we use it in combination sometimes to avoid the gross receipts tax. And that's legal, it's allowed.
So when we say in combination, for example, we might have an LLC as a general partner in a limited partnership. The limited
Absolutely.
partnership isn't subject to this gross receipts tax, but the LLC share might be a very small amount below the $250,000, and so no gross receipts tax would apply. And so anyway, so we can do these sort of combinations in some cases to help to reduce this tax exposure.
Correct.
Now, what about LLCs in California and professionals?
Well, in California, our legislature thought it wasn't appropriate for licensed professionals to be LLCs. That includes attorneys, accountants, architects, and dentists. It includes actually contractors. It includes generally people who have a license by virtue of the state of California cannot be an LLC. There's other forms of entities. We can use a C corporation or an S corporation for those types of individuals, but generally we use a corporate entity for those. I just want to add also, though, the LLC is a very attractive entity for owning real estate.
Oh yeah.
Except when that real estate gets to be too attractive or too productive, such as shopping centers. They may generate a lot of gross receipts. So again, we might use the structure that you're talking about with the LLC and the limited partnership.
Yeah. So yeah. So LLC, even from the beginning, to me, it seemed like they were made for real estate.
Absolutely.
And,
or small business.
Yeah. So, and even the license thing, actually I think that there's been some more recent developments that some of the licensed entities, for example, beauty parlors and barbers, that at one time they were saying that they weren't eligible. I think now they've sort of changed their position. So
they have on some of them.
Yeah.
Yes.
So you should check with the attorney, your attorney, for the details to see if LLC is available for your business, because they can be an attractive alternative to the corporate form in some cases. And again, another big one though that you mentioned along the way, it's because our world has become more flat, if you will, and that is that that we're getting more participation from foreign investors in businesses in the United States. And so these foreign investors can own interests in LLCs, and they can't in an S corporation, for example.
Absolutely.
And so they can be very attractive for that.
You know, partnerships can own interests in the LLCs. Foreign owners, as you said, trusts can own it. So it's a lot more flexible. So that's why it's very, very attractive to us.
Yeah, right.
A caveat here, though, is that for California residents, is that oftentimes people say, well, I'm going to form an LLC outside of California.
Oh, yes.
Now, the state of California has become very, very aggressive on this, and they've taken the position that anybody who, California residents who owns an entity outside of California is technically, from the Franchise Tax Board's position, not from mine, but from the Franchise Tax Board's position, the board's position is that that is considered a managed LLC, and therefore the management causes it to be doing business in California, and therefore they're saying it should be registered as a foreign LLC and subject to our gross receipts tax. There's ways of getting around that, but that's their position, and we're working with them.
Right. So we do need to be aware that there are these state tax issues, and we may have them for other states as well as California, but California is one of the most aggressive, and again, because of our gross receipts tax, it's somewhat unique. And as far as California is concerned, if you're a California resident, you're an owner of a business outside of the state, and you're saying you're a resident here, but they say, well, then you must be working here on this business. And so this income should be taxed in California. And so you're not going to get out of that very easily.
And California takes a position if a foreign LLC is doing business in California, it wants a piece of that,
too.
too.
Same thing, that's right, yeah,
Absolutely.
because they're doing business in California, subject to California tax.
One other thing that I wanted to mention is that LLCs are very, very attractive estate planning tools.
Oh, yes.
And as you well know, Michael, we use these for avoiding estate tax is if we can, legally. The IRS doesn't like what we do with these, but what we can do is we can actually shift income to members of the family, if done properly. And if structured properly, we can also get some discounting of ownership and make a much reduced gift to the family members, which is, as you well know, called the minority discount and lack of marketability discounts. IRS is very, very aggressive on this, but it's a very, very attractive tool for us as a state, for estate planners to use.
That's correct. Okay, I'm glad you brought it up. Okay, let's move on because time is going, and that is the next type of entity that we want to discuss is partnerships and limited liability partnerships. And what are some of the advantages and disadvantages of these?
Well, partnerships, one of the beauties of partnerships like the LLC is that it's deemed to be a pass-through entity. And we don't tax, in California, we do not tax our general partnerships and our limited partnerships with the gross receipts. They do pay their minimum franchise tax, but they do not pay any type of gross receipts tax.
If it's a limited partnership.
If it's a limited partnership, general partnerships, they charge next to nothing, and they're very attractive. The problem with those is that somebody's on the hook. In a general partnership, all the partners are on the hook, unless we use some combination of some of those other legal entities I was talking about. But in general, if you're just an individual owning an ownership interest in a general partnership, you're on the hook for unlimited, not just your investment. With a limited partnership, though, only the general partners are on the hook. The limited partners are on the hook only to the extent of their investment, which means they have limited liability protection to the extent that they have, to the extent that it's just their investment, I'm sorry, is what I'm trying to say. So in that instance, that can be very, very attractive from using the combinations as you suggested before. The other thing about partnerships that are very, very attractive for tax purposes, the debt of the entity is attributable to the basis or the investment for determining deduction of losses.
Right.
Very attractive for real estate, as you well know, Michael.
Right. So related to this, you have to sort of distinguish on the types of debt and the type of partnership and so forth. And some of this can get pretty involved, but I do want to throw out a sort of a general idea, and that is that if it's a general obligation, if you will, a general liability, then that can be allocated out to a general partner, and that person gets credit for that, if you will, as an investment in the partnership, and is able to take losses beyond the cash that they put into this thing.
The so-called full recourse loan.
Yes. Whereas for real estate, you can have a non-recourse loan that is in fact allocated out to the partner and get credit, but otherwise the non-recourse does not give you an investment in general. And this is also important in that limited liability company context and so forth. And the S corporation, even more so. It's like the liabilities, even for the non-recourse, those are all locked up inside of that corporation. You don't have access to them. So you're pretty well limited to the amount that you put in plus accumulated income. And if you make a loan, you actually have to make it outside of the S corporation, go to the bank, get a loan, and then put the money in there and take back your own note in order to get credit. Otherwise, you're not going to be able to deduct all of the losses of that corporation if they have them beyond that investment.
In this banking environment, you might have to do that because they're asking for all the guarantees of the owners. So,
But a guarantee isn't sufficient. If they make it to the loan, the S corporation, and then you guarantee that loan, it's clear that there's a lot of cases you don't get the investment.
So you might as well do the loan and then put it in.
Yuck. Okay. Well, the last type, maybe we should say, just before we move on, limited liability partnerships.
They're really restricted to the individuals that couldn't be, generally the individuals that could not be LLCs, the attorneys, the accountants, the dentists, the doctors.
So it's to give them some limited liability